Hello and welcome traders. Happy Tuesday. I am Rachel Deschelle, Senior Manager of Trading Services and your host for this Long Options webcast. I am joined in the chat today by my good friend, Kevin Horner. Please chat in your questions, comments, requests during our session today. We'll be sure to keep an eye on those throughout the session. And please follow us both on X. He is Kevin Horner CS. I am Rachel Dash CS. We post a lot of exciting things, and by exciting things, I mean charts and technical analysis. So please give us a follow there, and also please give this video a thumbs up. Please like this video and subscribe to us on Trader Talks at Schwab Coaching. So today I have a little bit in store for you, a little bit of trend trading, a little bit of scanning for short-term tactical opportunities. But before we jump in and get started, let's hit those important disclosures here. So options carry a high level of risk and are not suitable for all investors. The information that we're going to cover here is for general informational, educational purposes only and should not be considered any type of recommendation or advice. And we're going to cover a few trades on the Paper Money software application. Do keep in mind that there are some major differences between Paper Money and live trading. Now, one more important thing before we get to the agenda, we have some upcoming workshops and market drives. We have an exciting one coming up, Advanced Options in Dallas this weekend, actually. Some of my colleagues will be heading down there for that one. I think, Kevin, you may be at that one. Let me know if you'll be there in the chat there, but I know most of us will be at the Boston one in a couple weeks, and then we have the Chicago Market Drive event. That one will be very exciting as well. Definitely a lot to talk about in these markets, so that'll be definitely a good discussion at those technical analysis, option strategies, and market drive events there. Now, to get into our agenda for today, we are going to start by our market overview. So how we always start, then we'll review old trades. We'll get into discussing those concepts of long options, of price, time, and volatility, and then we'll place new example trades on the platform. So let's dive into Thinkorswim and really hit that market review today. So honestly, big things happening today, just because it looks like the S&P 500 is really battling with this 20-period simple moving average. I'm going to keep zooming into this so you guys can see it a little bit better. But yesterday, we reclaimed that 20-day moving average there. You can see it there in white. And then today it looks like we have traded below it. So we're trading below it right now. Of course, the day is not over yet. We still have roughly 3 hours of trading left. But so far, it's printing this inside day or this inside bar where you have this entire body of this candle that is basically enveloped in the last candle's body. And you also have a hanging man candlestick, which is typically a bearish reversal candlestick. And you may be wondering, well, the overall trend is down. Why is this still a bearish reversal candlestick? Well, if you look at the preceding price action before then, we had this little rally off of the lows. So that's kind of what it looks like, where you have this very small body, very long wick. That's typically a bearish reversal candlestick. But of course, we don't know that it is that until tomorrow passes and we see the follow through for that. So that's when that candlestick becomes confirmed there. Now, a couple other things. A few days ago, we did have a death cross with the 20-period or the shorter period moving average crossing below the 200-period moving average. So that one is notable as well. I think the biggest thing that traders will be looking for, if we can get past this 20-day, you have the 200-day up on the horizon right at that nice pretty round number of 6650. So that's going to definitely be one to keep an eye on. Something else I wanted to point out as well. So we have the Russell 2000 here. And I think something notable about this one is this one's actually held in pretty nicely compared to some of the other major market averages. We haven't spent more than 2 days below the 200 period moving average in this case, and it reclaimed its 20 period moving average a lot quicker. You're not seeing the death cross in the small caps either. So they're definitely still hanging in there and telling a different story than some of the other averages that we are seeing now. And then lastly, we're seeing the VIX climb a little bit more today. And I want you guys to just kind of understand what a VIX at this level will necessarily mean for a daily move in the S&P 500. So what you essentially need to do is you can take, I'm going to actually bring out my little annotation tool here. So you're going to take the current value of the VIX. So if the VIX is 26.38, you're going to divide that by the square root of 252. And why do we divide it by the square root of 252? Because there is 252 trading days in a year, so this is essentially going to tell us what a one-day implied move in the S&P 500 would be with the VIX at these levels. So if I take 2638, let's take 2638 divided by, I think it's 15.87, that gives us a daily move in the S&P 500 of 1.66%. So that means we are going to see some swings like we have been. So we are going to see some volatility. Just keep in mind that volatility can move in either direction here. I know there's a lot of headlines, a lot of geopolitical tensions, things like that are kind of right around the corner. So keep in mind that's typically what you're going to see as that daily move in the S&P 500. So now getting into reviewing some of our old trades that we have on. We have a couple old ones here. So I flattened the Oklo trade today. That was just one that we had from a couple weeks ago. We were long the 18th of June, 60 calls. That one we put on as kind of like more of that like volatility squeeze type of trade. So we're out of that trade now. We're still in our LEAP trade. So we're still in Halliburton. We're still riding the trend of that one. And we are also still in Ross Stores as well. So Halliburton does have earnings coming up. If we just kind of take a look at the trend on this one. They do have earnings coming up here in a few weeks. I think that would possibly typically, I mean, if you have shorter term options, typically it would give that long option buyer maybe some type of window to possibly exit to that long position, just because typically leading up to those earnings announcements, one, you have the uncertainty, and then two, you have a volatility increase typically leading up in the weeks up into that announcement as well. So we're going to keep an eye on this one. We are going to move our stop up yet again because we have seen, since we moved up our stop the last time, it's moved up even further from there and getting pretty close to that 20-day moving average there. So let's take a look at where we can move up that stop. Let's see where the option is currently trading. So it's currently 12.15 by 13.20. And we're going to replace our stop and just move this up a little bit higher. We're going to put a tight stop on in this environment that we are in right now. So we're going to place the stop price, or the activation price, which will trigger off of that asking price. We're going to put that right at $12, and we're going to place our limit about $1 below it, kind of just how the spread between the bid and the ask is on that one. Now keep in mind, with a stop limit order, with a stop order in general, there is no guarantee that you, especially with the stop limits, no guarantee that we will get filled at all, especially if we have those gaps down overnight or in the extended session and the price of the stock opens much lower. So keep in mind that's one of the risks there with the stop limit. And then obviously stop market orders, same kind of thing, except they're just going to execute immediately. So keep in mind with that one. So we're going to hit confirm and send, and we are going to send this order. We'll kind of see where that shows up on the chart. That looks a little bit better. So we're kind of theoretically possibly getting stopped out at that former high, which is going to be that area of near-term support. And in this type of market environment, even though we have seen outpacing gains and outperformance in energy, it's still kind of one of those times where we do still want to protect any profits and kind of take profits a little bit earlier here now. So that is that one there. And then Ross Stores, we're going to take a look at where we're at on that one. I don't think we've moved much from that. Same thing here. It looks like we are having a little bit of a support retest today. So this could give us an opportunity to move up our stop a little bit on this one too, since the price of the stock has broken out from this range to the upside and is retesting that level of short-term support. Now, keep in mind, these are longer dated options. So you do have a lot of time on these. These are more of a long-term type trade. So we're going to click on our order, cancel replace order. And let's take a look at where we're at. So we're going to move this up to 38. So we're going to move that up to 38. We're going to hit confirm and send. Keep in mind, again, with that stop market order, that is going to trigger off of the asking price. When the asking price hits that trigger price, it's going to become a market order. So just be aware of the risks there, that you are accepting that next available price, whatever that may be. So that is what we're using on this one. So hit send, there we go. And there we go. We moved that up a little bit as well. Okay. Now let's see if we have any questions. I don't think we do so far. So, the theme of today is going to be finding tactical opportunities below the 20-day moving average. So we're going to use all of the different concepts within long options like time, volatility, things like that, to put together a scan to look for some of these maybe short-term bearish tactical opportunities here, since the overall market, or the S&P 500, we're using that as our index today, is battling with that 20-day. We're going to scan for stocks that are doing the similar thing, that are already in that longer term downtrend. So what we're going to start with on the scan tab is we're just going to look in all listed stocks here, all listed stocks. And one easy stock filter that I just like to put there to filter out a lot of lower price stocks that may have necessarily like thinner traded options, or necessarily won't see a huge move on the options, will be above 20. I'm going to add another filter here for a study, and let's go to volume, because we talk about volume a lot in this class as a measure of liquidity. And so if you have a more liquid stock, typically the options may be a little bit more liquid as well. So for this one, we're going to put in a study filter for average volume. We're going with the 50-day average of volume greater than 1.5 million here. And let's put in a couple other filters. And a couple other filters that we're going to focus on are going to be regime based. So what type of volatility regime are we in? Now, the overall market, you guys saw in the beginning, we talked through this in the overall market. We We're in a heightened volatility regime from just looking at the S&P 500. Now, does that mean that all stocks in the S&P 500 have high levels of relative volatility right now? No, that does not. There are a lot of stocks out there, all listed stocks, looking within that list that still have lower relative levels of implied volatility. So we're going to look for some of those because we know as option buyers, we do not want to be buying options in a higher implied volatility environment. And why is that? Well, we don't want to overpay for our options. The option prices are going to be very inflated with that level of implied volatility. And so if we have higher implied volatility, that's a better environment for being a seller of options, which the majority of the market right now, that's probably what we're going to get is that it's giving us an environment to be sellers of options in that case. But that's why we're going to narrow this list down quite a bit, and we're going to look for options with a lower implied volatility, and I'll show you exactly how to do that here. So let's take a look here at our filters. So we're going to add a filter and we're going to go to study. The first thing we're going to do is if we're looking for short-term tactical opportunities, these are opportunities that may be about a month or more in time, because we talked about looking at that 20-day moving average. That's about a month in trading activity. So we're going to make sure that we're going to search for corporate actions within the earnings section here, and we're going to make sure we look for stocks that do not have an earnings announcement anytime in the next 30 days, so in the next month. Okay, so that's going to be the first thing that we kind of filter out here, because we already talked about how leading up to earnings we're going to have higher levels of implied volatility. That would be something that we would want to avoid, is trading around that time. And we're going to add another filter, and we're going to go to study here, and let's go down to volatility. So if we select implied volatility percentile, now there's a few different volatility filters here that you can play with, but if you look at implied volatility percentile, this is going to tell us where the current level of implied volatility for that specific security is compared to the last year of that security's implied volatility data. So it'll tell if it's relatively high, near the 100th percentile, or if it's relatively low, near the 1 percentile. And I did see that there is a survey in the chat. Thank you, Kevin, so much for putting that in there. If you guys would take just a moment to fill out that survey, I believe it's 2 questions. It probably takes you about 10 seconds unless you're one of those people that likes to type a little bit more feedback. And I will tell you that feedback is always welcomed here. I read every single comment of your guys's, and I try to incorporate that as much as I can into these webcasts. I know all the coaches do, so definitely please take the time to fill that out. Your critical feedback will definitely be very appreciated and well received. So thank you so much. Now let's get back into this scan. Okay, so the implied volatility percentile, we're going to look at a percentile of 0 to 50. So this is going to look and tell us the lower half of implied volatility rankings of the last year. So we're definitely looking in some of those lower implied volatility environments as that kind of measure to buy those options. Now, the next thing that we want to look for as well is just a very simple trend indicator. And you guys know, you've seen me teach this class for I think 6-7 months now. I like to keep things pretty simple. I don't like to get too complicated with a bunch of different indicators and studies and scripts and things like that, because I believe the best signals come from simplicity. So that's why we're going to add just a simple study filter for a simple measure of trend, and we're going to look down at custom here. And we're just going to click edit. We're just using that simple condition wizard command here. And we're going to look for price, a closing price that crosses below study We're going to type in simple. A 20 period simple moving average within the last 3 days. Okay, you guys see how I did that there? I know I've done this before in this class, but repetition always helps. So we're selecting price, we're selecting close, we're saying crosses below this study of simple moving average, changing the length down here to 20, and we're saying within the last 3 days. So if we hit save, this is going to be a really simple script for that one. The close crosses below the simple moving average within 3 days. And we're going to hit, we're actually going to add another condition. We're going to say the price of the stock is less than the 200 period moving average as well. So this stock is already in a sustained downtrend, and it may have just recently rallied back up to the 20-day or traded above it for a little bit and is now trading back below it. So we're going to go with that one there and hit OK. Now keep in mind, I am showing this in a paper money account, but keep in mind that these study filters that you're going to see here, whoops, on the add filter, these study filters only work in live trading. So when I share this scan with you guys, or if you guys are walking along with this with me, keep in mind that these are only going to show up in live trading. Okay, so I'm going to hit scan here on this one. We're going to wait for the results, and this is going to give us 11 different stocks here to check out. Okay. So I'm going to actually share this scan with you guys. Just know that these scans and scripts are not guaranteed for accuracy, timing, or results. But again, just another very simple tactical bearish type scan that we can kind of go through here to use as an example. So let's take a look at some of these different charts here on this one. So I'm going to click save scan. We're going to save this scan query, and we're going to name it short-term bearish. We're going to name it 20-day, 20 DMA. Okay, hit save. Now what I'm going to do is I'm going to take that scan, I'm going to add a watch list over here on the left-hand side, and we're just going to make this a really easy way to link our watch list to, there we go, our watch list to our charts. So if you guys can kind of see how I did that, if you're new to Thinkorswim, it's a very easy way to do that. Okay, so let's take a look through some of these different companies here. So let's take a look at Dollar Tree. This is one of them that came up on the scan. And if you guys can kind of see what we're seeing in the trend for this one, very similar type action here to what we're seeing in the overall market index as well. We had this consolidation up here for quite some time, for a few months, and then the trend broke down, made a lower low, and has still made a lower high. Now you can see just recently that price came up and kissed the 200-day moving average a couple times, but hasn't been able to keep a sustained movement above either the 200-day or the 20-day moving average here in this one. So price is looking like it's consolidating a little bit within this ongoing downtrend here. And of course, today we're kind of powering that through that a little bit more. Let's take a look at where implied volatility is on this one as well. So if I just kind of show the implied volatility study, we can take a look at where implied volatility is currently compared to where it has been the last year. And we're going to draw this little line here to make it easy to see kind of where it is now. We can probably see that we're definitely in the lower half, probably even a little bit lower as far as the relative implied volatility. If we are a short-term bearish in Dollar Tree, where we are trading below major levels of resistance, we may have a couple extra layers down here, maybe of support. few dollars down the way, that could be the direction that we may possibly be heading with this stock. So what we're going to do is we're going to take that short-term bearish thesis, we're going to play that out as far as buying an option now, buying a put option to take advantage of a downward move in the stock. So couple things we're going to keep in mind. So we're looking short term, which means we're looking at that 20 period moving average in this case. So that's in white. So that's telling us about the monthly trend. So we know as an options trader, when we think about our time decay on our option, we know that time decay doesn't exactly work in our favor when we're buying options. So typically we want to give ourselves a little bit more time so we don't see that time decay on our option. And typically that time decay, that theta decay, really kicks into high gear right around that 30-day mark out from expiration. So that theta decay just gets quicker and quicker, or I guess larger and larger, which translates to quicker and quicker evaporation of premium as it pertains to that time decay. So we're going to keep that in mind, maybe go roughly about 2 months out or so to just trade this short-term trend. So let's move to the trade all products tab and let's take a look. Well, down below, we do have that current implied volatility percentile of 30%. So that tells us that Dollar Tree is in the lower third of where its implied volatility has been in the last year. And then if we're going to look about 2 months out from expiration, that puts us right at that 18th of June 2026 with about 72 days left until expiration. So it's a little more than 2 months out from expiration here that we're seeing. Okay. And now if we just look at the options here, we're going to focus on the right side of this to look at the put options. We have our in the money options there highlighted in purple. Those are options that have intrinsic value. That means that the price of the stock is trading lower than the price of those options. And then we have our out of the money options here in black. Now in this class, we typically look for an option that is in the money that does have some bit of intrinsic value, and we typically look for a larger delta as well. And the reason why is because typically those options have one, a higher probability of that option expiring in the money, which is what we're looking for it to do. And then the second thing is that if we are correct on our directional assumption on this particular stock, we have a greater move on the option as well. So that is what we're going to look at when we take a look at our delta here. So if we just take a look at our delta, we can see that if we're looking at, let's say, more of the at the money option or slightly in the money option of a 110, we could see that gives us a delta of about 53 cents, which tells us that if the price of the stock is going to go down $1, our option is going to gain 53 cents. So that's why you have that negative sign next to the delta, because puts are going to obviously move inversely to the price of the stock. So if the stock goes up, our option is going to go down and vice versa. So we're going to look at we're going to look at this one, this 110 strike here. We can see that there's a pretty tight spread on the option, and by tight spread, I mean, we're looking at the difference between the bid and the ask is less than 10%. So that is definitely key here. That is a pretty tight spread. We also have a decent amount of open interest, a little bit of volume on the day as well. But that's really what we're going to take in crafting our strategy here on Dollar Tree. Now, another thing I want you guys to keep in mind with this one as well. We talked a little bit about time decay, and I mentioned theta. You can see that right here in the theta column here. You're going to have the highest theta decay for options that are at or near the money. So keep that in mind. If you want a little bit less theta decay, but you want kind of that that balance of directionability and price. You may want to offset that with your delta as well, because you'd have a little bit less time decay when you're either looking further out of the money or deeper in the money with theta decay as well. And then Vega, that's going to tell us our sensitivity to a 1% change in implied volatility. So this option, if implied volatility goes up 1%, our option should theoretically go up roughly 19 cents there. So keep that in mind. Now with this one, we're going to look at the 110 I mentioned. We're going to right click on this option. We're going to buy custom with OCO bracket. Okay, so we're going to click on that, and that is essentially going to create this first triggers, one cancels another. So this is going to allow us to place an entry order, and once that triggers, it is going to allow us to place a profit target and a stop loss along the way as well. So that is what we're going to do, and we're going to stick to pretty hard and fast rules today of looking for a 15% gain and then also stopping out at a 20% loss. So we're going to do the math here. The first thing that we're going to talk about is we started with an account size of $200,000. So we know that we have about $10,000 or about a 5% trade risk. So we have $10,000 that we could essentially place into a trade. And so what we're doing essentially when we're buying this option, we're saying we think the price of the stock is going to go down, and the most we can lose is the premium that we are paying. So let's say we do 5 contracts here on this one. I'm going to show you guys on the confirmation screen. You guys can see that our max loss, our total risk on this trade is going to be the premium that we're paying. So it's going to be 5 contracts, or I guess you could take 500 since you're controlling 500 shares multiplied by that premium of 1060. And that's where you're getting that max loss of 5,300 in that case. Now, we are in that type of market environment where we may want to reduce our position size a little bit, not necessarily swing for the fences type of environment. So that is why I'm starting with a smaller trade here. We're putting less than $6,000 into the trade. We can spend up to $10,000, but that is what we're working with on this one as well. So let's do some quick math here. We're just going to look for a simple 15% gain on this option. So essentially, if we take 1045, which is our entry, multiply that by 1.15, that would put us right at 1201. 1201. And we can do a little theoretical calculation to see where the price of the stock would have to go for our option to reach 1201. Now on the downside, let's take 1045 on the downside, multiply that by 0.8. That would give us a 20% loss to cut out our losses there. And that puts us at 836. Okay, so we obviously have a tight stop on. We're going to take profits quickly in this one as well. So we have a 15% gain on the upside, 20% loss on the downside. Now, most of you traders may say, I don't really like that risk to reward. Well, you can definitely change that as well. We are just essentially making sure that we are taking profits rather quickly, but also having that tight stop to the downside. So we're going to do 5 contracts here. Keep in mind with that stop order there, that is always, when you're selling, it's always going to trigger off of that asking price of the option. So when that asking price reaches 836, this option becomes a market order. So there's no guarantee at what price we will be filled at on this one, but we're using that one in this case just because it is a tighter spread there. But keep in mind, you may not get a fill close to that current price. Okay. So we're going to click confirm and send here, place this in our long options class and hit send. Okay. Okay. So we have that in there. Now, Laura, you mentioned I'd prefer a higher gain percentage than a loss percentage. Yes, a lot of traders may look for either a 2-to-1 gain or risk to reward, or a 3-to-1 even. So definitely opportunities to tighten up that stop or raise your profit targets in this case. The reason why we did this just today is because if the price does move in our direction, we want to take pretty quick profits. So let's work with another one here. Let's see. Okay. We have a few on this list. So let's take a look at let's look at NVIDIA. Let's look at NVIDIA here. Okay. We're going to look at NVIDIA, and we're also going to look at this on a short-term chart as well. So NVIDIA has been a little bit choppy as far as the price action. So if you guys can just kind of see this, we have had this massive range really that we actually just kind of broke down from the other day. And now we're kind of stalling out at that familiar level of resistance. So I'm going to zoom into that a little bit more here so you guys can see. Now, some traders may look at this chart and they may say, hey, this longer term range may give me some opportunity to sell options outside of this range. So some traders may look at a range and say, hey, if there is a higher level of implied volatility, this gives me the opportunity to maybe sell an iron condor, or maybe sell a put spread down here, or sell a put in general. But we know that implied volatility is a little bit lower in this name. And if we just look at the short-term trend, I'm going to take the longer-term trend away. If we just look at that shorter term trend, we can see that the price, I mean, really ever since the end of February, the price has not been able to spend more than one day above that 20 period simple moving average here. And you can see even with that bullish engulfing candlestick last week, we didn't have much follow through. Our only follow through was a little tiny bit of a movement into that 20-day, and then we had that rejection there as well. So this is going to be one, we'll use this as an example, just kind of using the same framework we used before. We can see implied volatility is relatively low, gives us a favorable time to be buying options. And if we're looking for that short-term opportunity, let's go again with that 2 months out from expiration rule here. So let's take a look at NVIDIA. We can double check that current implied volatility percentile. That is pretty darn low there at 17. So 17 out of 100 tells us we are at a pretty low implied volatility environment for NVIDIA. And if we take a look at the 18th of June, that'll give us about 2 months out from expiration. I can scroll all the way down to the current prices here, and let's follow a similar framework that we did on our first one. So if we're looking for an option that is slightly in the money, so let's take a look at an option that is about... Let's take a look at the 183 strike put here. Okay, so this has a pretty tight spread. You're going to have pretty tight spreads with NVIDIA. It is a very actively traded stock, obviously. Has definitely the highest weight in some of the indexes as well. So we're going to go with that one. It has quite a bit of open interest too. So we're going to right click on the 183. You can see a delta of 54 cents, which is going to tell us, hey, with a $1 move in the stock, we're going to have a theoretically 54-cent move inverse the stock. Theoretically, we're going to have a roughly 7 cents of time decay per day. We're going to have roughly about a 31-cent sensitivity to any 1% change in implied volatility as well. So keep that in mind. Okay. Now, let's take a look. I have a question in the chat. It would be helpful if you could show the Analyze tab so we can get a clearer view of the potential profit, Frank. That is a great idea, and you actually read my mind. We're going to right-click on this one. Actually, we're going to click on this one just to analyze this trade. So I clicked on the asking price of that option to buy that put. I'm going to right-click now on this trade ticket and analyze this trade for us. Okay. Now we're going to go to the risk profile tool, and I'm going to clear out old trades here. Something you want to always make sure you do when you go to the risk profile tool to be able to analyze your risk on a trade, you're always going to make sure that this date in the upper right hand corner is the day after your expiration date. And the reason why is because we want this model to contain your last day of trading. So we're going to make that June 19th. You may wonder why this option is expiring on a Thursday. Well, now we have Juneteenth as a holiday, so that is a market holiday there. So we're going to select the 19th there, and this is going to give us a view of what our potential loss and profit is. Now, what a lot of traders may do is they may look at this shaded kind of mark in the background, and that's going to tell us what that's going to essentially tell us one standard deviation of price action. So if price action is kind of right in the middle here, that's going to tell us that, hey, this entire gray shaded area is going to encompass the price action here. Now, these two lines that you're seeing here on the background of this chart, the blue line is what your risk looks like on expiration. The purple line looks like your risk today. The difference between those is that time and implied volatility value, or that extrinsic value that is still left in the option. And so you can see on the x-axis, we're going to see more of a loss and our loss capped out down here at 1570 as the price of the stock goes up. Now, if you can see, I'm hovering over kind of this upward sloped area. This is as the price of the stock goes down, it's going to tell us where our profit potential is. So as I move my mouse along this, let's just say I let that mouse rest right around 160. If you look in the lower left-hand corner of this graph where it shows you the dates in purple and blue, that will tell you the potential profit that you would see with that type of move in the stock by that date. So we're saying if the price of NVIDIA goes down to 160, we're going to be at about $1,000 gain a day. On expiration, we'd be at about a 700 gain. The difference there is that time value you're going to lose. So if we take this little 3-line menu here on the right, we go to set slices to break even here. It's going to put our slice right on the difference between where our profit would have to be between now and expiration. So it's kind of giving us our probability of profit in this case. So hopefully that helps there. Now let's quickly go back to this trade and build this trade together. So we're going to right click on the 183. We're going to buy custom with OCO bracket. We're going to use those same rules that we used before, and we're going to do about 4 contracts in this case. So you can see that the 4 contracts is going to equate to a max loss or a max risk of about $6,300. So we're still staying within the risk parameters of our account here. We're going to make these all good till canceled as well. So we're going to enter at 1575 at the current price. We're going to look for a 15% profit. So we're going to take 1.15 times 15.75, and that gives us 1811. Okay, and then we're going to use our stop. We're going to put that at a 20% stop. So we're going to take 0.8 times 1575, and that'll give us 12.6. So similar risk to last time with that stop market order. Again, a trader may assess this a risk to reward. Again, we're doing this just to take quick profits if the price of the stock does go down. If you do want to see where the price of the stock would have to go to by a certain date to reach 18, all you guys need to do is use this Theo Price Mark tool right here. And this will kind of give you that measure of that as well. So you can kind of play with those dates, play with the volatility adjustment, play with the stock price adjustment, and that will show you that Theo price on that. Whoops, did I just entirely lose that trade? Yes, I did. Okay, we're gonna try that one more time. So we're gonna go to buy custom with OCO bracket. I'm gonna try to build this as quickly as possible here because I know we're almost at time. And we're gonna put this right at, I think this was 1811 or so. And then our stop 0.8 times 1585, that was around 1268. Okay. So we are going to hit confirm and send. We're going to place this in our long options section there, and everything looks okay to me. We're going to hit send. Okay. There you go. Okay, so hopefully this helps you guys just look for maybe some short-term bearish tactical opportunities, especially since we are in an overall higher implied volatility environment, which isn't a great time to be buying options. And we are currently trading at the major averages, especially the S&P 500 below that 20-day moving average. So this kind of gives you just a little bit of a framework, a simple way to just scan through the markets, still find opportunities for long options because they do still exist out there. And we showed you how to take profits a little bit quicker, take a little bit of the smaller position size in this type of environment that we are trading in. So hopefully this helps today. If you like this video, please smash or click gently on that like button. And please also give Kevin and I a follow on X. He is Kevin Horner CS. I am Rachel Dash CS. And then please also subscribe to us on Trader Talks at Schwab Coaching. But thank you, everyone, and I will see you later, traders.